Welcome to The Explainer. Today we're tearing into a deeply speculative, highly detailed equity research report on USA rare earths. That's ticker symbol USAR, currently trading right around $17.11.
So what exactly is USAR? You really have to look at their ultimate ambition here. They are a strategic platform currently in the build-out phase. Their goal? To create a fully integrated Western rare earth supply chain literally from scratch. We're talking mine to magnet. Now, you absolutely cannot look at this as your standard profitable mining stock today. It's an emerging, highly strategic infrastructure play. Mine to magnet means they want to control the rock coming out of the dirt, the complex chemical separation facilities, the advanced alloying foundries, and the final magnet manufacturing floors. The whole shebang. The entire investment case hinges on successfully executing those separate assets and eventually crossing over into positive cash flow.
Okay, let's dive into this because the geopolitical moat surrounding this space is massive. The fundamental bull case for USAR is unusually powerful, and it all starts with one stark reality. China currently controls roughly 60% of all global mined magnet rare earths. And why does that specific percentage matter so much right now? Well, the International Energy Agency projects that demand for these magnet rare earths is going to spike by more than 30% by 2030. That surge is fueled by massive structural megatrends. Think mass adoption of EVs, offshore wind turbines, advanced defense systems, and the explosive power demands of all these new AI data centers. We are staring down the barrel of an impending demand shock, yet the raw material feeding that demand is fiercely centralized in just one region. It's a precarious breaking point for global supply chains.
But wait, the bottleneck gets even tighter, and honestly significantly more alarming as we move downstream. When you look at refined magnet rare earth production, China's share jumps to an astonishing 91%. Refining rare earths is famously difficult. It involves incredibly complex, highly specialized chemical processes, brutal environmental management constraints, and technical know-how that literally takes decades to perfect. China has essentially industrialized and mastered this entire value chain, while Western nations are just now waking up and trying to rebuild this capability from absolute scratch. This extreme monopolization creates a massive, unprecedented premium for any viable Western supply alternatives that can actually make it to market.
And then we hit the absolute apex of the problem at the final stage of the process. 94% of global permanent magnet production is controlled by China. Just imagine relying entirely on a single foreign nation for the crucial motors inside every electric vehicle, every wind turbine, and every single advanced defense system your country produces. That is the catastrophic risk the West is facing today. This severe vulnerability is exactly why Western governments are so highly motivated and frankly financially incentivized to prop up companies like USAR. Remember China's 2025 export restrictions? Automakers outside of China were actively struggling to source magnets, causing massive production headaches. The world is rapidly waking up to the fact that treating these critical technological components as standard global commodities just isn't a viable strategy anymore.
So, how exactly does USAR plan to break this monopoly? While they're attempting to build an integrated chain by stringing together physical assets spanning the globe, let's walk through that real-world supply chain. It starts in the dirt at the Round Top project in Texas, which focuses on heavy rare earth mining and processing. That foundational supply is then significantly bolstered by active, ongoing production at Serra Verde down in Brazil. From there, the materials cross the Atlantic to the UK, where USAR owns less common metals. That facility gives them tangible commercial capability and highly specialized expertise in creating rare earth alloys. Finally, those alloys come right back to the U.S., specifically Stillwater, Oklahoma, where they are actively ramping up a permanent magnet manufacturing facility. This vertical integration, from the mine to the concentrate to the separation to the alloy and finally the magnet, that is their core strategic advantage.
Now, if management can successfully string all these far-flung global assets together into one cohesive machine, the endgame is truly massive. They are projecting the combined, fully integrated company to reach approximately $1.8 billion in EBITDA by 2030. But here's the absolutely critical part to understand. They're targeting roughly an 80% cash flow conversion on that figure. Let me explain why that's a big deal. An 80% conversion rate is extraordinarily high. It's basically the ultimate holy grail of a fully integrated margin-stacking business model. You capture the profit at every single step of the value chain, rather than bleeding margin to third-party processors. This robust, high-margin endgame, that is the central valuation bridge that makes the stock so incredibly compelling to the bulls.
Now, what's really interesting about this slide is the sharp, honestly somewhat jarring contrast to that future billion-dollar dream. For the second quarter of 2026, USAR's actual recognized revenue was just $5.82 million. Yeah,
You heard that right. While that figure is technically up significantly in percentage terms from their previous leaner years, reporting $11.5 million for the entire first half of 2026, economically, it's tiny. It is a drop in the bucket relative to the company's current multi-billion-dollar equity valuation. You are paying today for what the company hopes to be tomorrow, absolutely not for what it is currently earning.
And that brings us directly to the very real bear case here. USAR is deeply, aggressively loss-making. In the second quarter of 2026 alone, they posted an operating loss of $46.3 million, alongside an operating cash burn of nearly $57 million. And that word, burn, needs to be emphasized. You simply cannot look at a company burning nearly $57 million in cash against under $6 million in revenue and extrapolate those current margins into the future. They are carrying massive corporate overhead, incredibly aggressive R&D budgets, and immense development costs. Let's be clear. This is not a mature business. It's a pre-commercial infrastructure play that is burning substantial cash right now just to build out its foundation.
Now, to survive that kind of intense cash burn, you absolutely need a fortress balance sheet, and this is arguably one of USAR's strongest, most reassuring features. As of June 30th, 2026, the company was sitting on a massive $1.53 billion cash pile. This war chest provides critical flexibility for their immense future capital requirements. But let's keep in mind what $1.5 billion actually means in the context of heavy industrial mining. While it sounds like an infinite fortune to most of us, building out new greenfield mines and state-of-the-art chemical refining facilities eats through capital at an astonishing rate. Having cash on hand today does not mean the company is fully funded all the way through to its 2030 commercialization goals. They will inevitably need billions more to fully realize this entire vision.
Thankfully, they aren't relying entirely on the whims of the equity or debt markets to bridge that gap. USIR has secured strategic agreements giving them access to up to $1.6 billion in funding capacity through the U.S. Department of Commerce under the CHIPS Act. Having the backing of the U.S. government substantially reduces their long-term financing risk. However, and this is a massive however, it is absolutely crucial to note that these disbursements are strictly milestone dependent. The government isn't just handing over a blank check here. If USIR stumbles on construction, if they miss production targets or face unexpected delays, that government tap gets shut off instantly. That means their execution risk is directly and intimately tied to their ongoing liquidity risk. And speaking of execution risk, that brings us to their most critical operational catalyst to date. The recent Serra Verde acquisition down in Brazil is the single most important strategic development for USAR. This specific transaction is what aims to turn them from an aspiring pre-revenue developer into a true operating platform. Serra Verde is an already producing rare earth operation, which instantly de-risks a huge chunk of their supply chain. Crucially, it gives them highly strategic exposure to heavy rare earths, specifically elements like dysprosium and terbium. Why do those matter? Well, heavy rare earths are strictly required to manufacture the high-temperature permanent magnets used in electric vehicle motors and advanced defense applications. Without dysprosium and terbium, the entire Western EV transition literally stalls out.
The reason the Serra Verde asset is so genuinely transformational is the immediate financial impact it's projected to have on the combined entity. Under management's current assumptions, Serra Verde is expected to crank out between $550 and $650 million in annualized EBITDA by the end of 2027. Think about that for a second. Contrast that massive projection with the $46 million operating loss we were looking at just a few moments ago. If management actually achieves this integration and hits these targets, it fundamentally transforms USAR's financial profile overnight. It completely pivots the narrative from a speculative, cash-burning startup stock into a legitimate, massive earnings generator.
So the crucial point is, what did current shareholders have to give up to get their hands on Serra Verde? To acquire this asset, USAR issued approximately 126.8 million new shares. That takes their share count from roughly 244 million way up to a newly inflated pro forma count of about 371.5 million shares. Take a moment to digest that math. Existing shareholders effectively gave up about a third of the entire company to finance this deal. This severe dilution is a bitter, bitter pill for retail investors to swallow. It also means you absolutely cannot calculate USAR's future valuation or target price using only the pre-transaction share count.
Because of this massive new scale in shares, paired with their tiny current recognized revenue, traditional valuation metrics look completely broken right now. If you glance at the current price-to-sales ratio, calculating annualized current revenues of roughly $20 million against a pro forma market cap now sitting in the billions, the stock trades at well over 200 times sales. Honestly, to a traditional value screener or a conservative portfolio manager, this stock looks completely uninvestable. On paper today, it looks wildly, dangerously overvalued. But this is exactly why standard backward-looking metrics fundamentally fail when you're analyzing pre-commercial infrastructure plays.
See, the market isn't buying current sales. It's pricing in future optionality and massive geopolitical necessity. Let's walk through the forward-looking math for a second. If Serra Verde successfully closes and actually hits that $600 million EBITDA target, and we assume an enterprise value of around $5 billion for the combined company, suddenly we're looking at a forward multiple for 2027 of just 7 to 10 times EV to EBITDA. When you stretch the timeline out and actually look at the earnings power of a fully integrated platform, that roughly $6.35 billion pro forma equity value actually starts to make fundamental, logical sense. Actually getting to that multiple, however, requires navigating a truly overwhelming execution load. Management isn't just casually checking boxes here. They are engaged in a massive, high-stakes juggling act. Think about it. They are simultaneously trying to integrate a massive foreign mining operation in Brazil, scale up highly complex downstream magnet production right here in the US, develop an entirely unproven greenfield mining project at Round Top in Texas, and meet strict construction deadlines to secure milestone-dependent government funding. Oh, and all of this while navigating wildly volatile global commodity prices for rare earths. Missing targets on literally any of these spinning plates could easily trigger a 30 to 50% drop in the stock, even if the underlying long-term thesis remains perfectly intact.
And this brilliantly illustrates why a traditional discounted cash flow model is essentially useless here. Because of all these spinning plates and the binary nature of infrastructure development, we really have to look at a probability-weighted scenario model. The sheer range of outcomes mapped out by the analysts is staggering. If integration fails, funding dries up, and rare earth prices drop, the bear case sees the stock plummeting to between $7 and $13. That's a catastrophic loss for anyone buying today. But if they simply execute the base case and get these assets online smoothly, we're looking at a $28 to $35 stock. And hey, if USR truly executes flawlessly and becomes the dominant Western rare earth platform in an extreme bull scenario, this is a genuine multibagger capable of returning well over 300% from today's prices.
Because of this extreme inherent volatility, the research report gives USAR a very specific 6.5 out of 10 conviction rating, classifying it strictly as a speculative buy, meaning this absolutely should not be the core holding of a conservative retirement portfolio. The analyst's disciplined strategy here isn't to just lump sum invest today. Instead, they suggest strict dollar-cost averaging, buying small starter positions in the $16 to $18 range, getting much more aggressive if it dips down to the $13 to $15 level, and treating the $11 to $13 zone as the point of high-conviction speculative buying. Conversely, if the stock rips above $22 without fundamental confirmation of those key execution milestones, the advice is simple: hold and do not chase the momentum.
Ultimately, analyzing USAR rare earth comes down to looking past the short-term noise and focusing on the core structural reality of the global economy. The West desperately needs an alternative to China's 90+% stranglehold on the critical magnet production that literally powers our future. But for you, the investor, analyzing this equity requires weighing two opposing forces. So here's the billion-dollar question. Can USAR successfully execute its way into becoming a $1 to $2 billion EBITDA company without totally destroying its existing shareholders through massive, repeated dilution along the way? The geopolitical potential is undeniable, and the rewards for success are immense, but the operational risks are just as steep. Keep a very close, objective eye on those execution milestones.